Hi and welcome to Swissquote's Daily Market Talk. It's Monday, October 14th. The Chinese said that they have significant fiscal stimulus plans on Saturday, but they refrained from putting a number on their plans. Then, the Middle East tensions remain on the headlines, unfortunately, but Israel hasn't made a move on Iran just yet. Then the big US banks kicked off the earnings season last Friday and they have announced quite positive results, and more banks and big technology names are due to announce their quarterly results throughout this week, while the European Central Bank is broadly expected to announce another 25 base point cut this Thursday. So tune in, the week will be packed with news and events. So China didn't pull out the fiscal bazooka on Saturday, but said that there will be a significant bond issuance to help reverse the deepening property crisis and local governments, while Israeli didn't attack Iran this weekend, but some reports in the headlines hinted that the Israeli army could be narrowing their targets on Iranian military and energy infrastructure. As such, crude oil kicked off this week quite downbeat. The barrel of US crude is trading below the $75 per barrel mark this morning in the early hours of Monday trading, and Brent oil consolidates near the $78 per barrel level. Now, the short-term risks remain tilted to the upside. We could see a sudden spike in oil prices in case the Israeli attack materializes on Iran, but the careful steps from the Chinese government when it comes to all of these announcements regarding their fiscal stimulus plans actually keeps the medium to long run investors in oil on hold for now, and reminds also everyone that Xi Jinping, he doesn't like the kind of market euphoria that investors expect from his government. Because remember, he also hated the vibes around the Chinese big technology companies a couple of years ago. I think that actually cost the Chinese big technology names their place in global technology portfolios among their major global peers. And in return, investors don't like the fact that the ample monetary stimulus measures from the People's Bank of China may not be channeled toward the right places in the absence of an efficient and a comprehensive fiscal stimulus package. So it is all very much blurry right now. The only certainty about China is that China needs stimulus to overcome its deepening property crisis and fight deflation in China. Because the figures released during this weekend actually show that consumer price inflation in China was flat in September. It was 0%, while the decline in producer prices accelerated to 2.8% year on year. And the stock markets gave a mild reaction to the avalanche of news and data this morning. The CSI 300 is up by 1.5% at the time I'm talking here, but the index sank last Friday into the bearish consolidation zone on the latest rally that was triggered by the news of major monetary stimulus from the People's Bank of China. So we will probably see the volatility and the latest gains fade for the CSI 300. The Hang Seng Index, on the other hand, is down by around 0.40% today, but holds ground near a minor 23.6% Fibonacci retracement, because the index is still in a bullish trend, but gains here will probably slow down as well. Then, China-related commodities like copper and iron ore, for example, are mixed this morning. And they're swinging between hope that China hasn't got another option but to do whatever it takes to reverse the fortunes of the country, as the Aussie dollar is consolidating near its 50-day moving average and the major 38.2% Fibonacci retracement that stands near the 0.6720 level, and that should distinguish between the actual bullish trend in the Aussie dollar and a medium-term bearish reversal. Now elsewhere, The US producer prices data last Friday came in, well, quite mixed. Well, we'll look at the figures. The monthly figures were lower than expected by the analysts, but the yearly figures were stronger than expected, and the core PPI in the US advanced to 2.8% level. Now, the figures didn't change the November expectations regarding what the US Federal Reserve could do with its rate policy. The expectation is still that the Fed will likely cut its interest rates by 25 basis points, with nearly 87% chance assessed to it, but it becomes clearer by the day that the Fed won't attempt another acrobatic move on its rate policy in the coming months, and that the US dollar could consolidate at the actual levels and even further extend its gains as the other major central banks around the world will be adopting their policies to a more dovish stance. And in this context, the ECB will meet this week and is expected to announce another 25 base point cut on Thursday, as the September CPI should also confirm that headline inflation in the Eurozone actually fell below the bank's 2% monetary policy target just a few hours before the ECB decision. Now, the only unknown is what the European Central Bank thinks about the stickier core inflation that's hanging around the 2.7 to 2.8% area right now. So the euro-dollar pulled out the major 38.2% Fibonacci support last week and extends losses within the medium-term bearish consolidation zone right now. The next bearish target for the euro-dollar stands near the 108.75 level, which is the 200-day moving average. That will either give support to the pair on the back of a cautious ECB cut or be cleared on the back of a helpful and a dovish cut. So Lagarde will tell on Thursday. Across the channel, the British CPI due Wednesday is also expected to confirm that the British inflation has also come below the Bank of England's 2% policy target, but core inflation there is still near the 3.5% level. So the Bank of England Governor, Mr. Bailey, had recently told investors that the bank is about to get more aggressive on its rate policy, remember? So that was obviously a comment that had actually triggered an aggressive sell-off in pound sterling, remember? So this week's CPI data, inflation numbers from Britain could either give more substance to Bailey's comments and send cable below the 130 mark, or not, because traders will also have a very close look to the services inflation in Britain before eventually sending the pair below that important 1.30 psychological support. Because if services inflation in Britain remains sticky, then the Bank of England could hardly get aggressive on its rate policy. In the stock markets, the S&P 500 finished last week with a fresh record high again, as the first big bank earnings came in better than expected by analysts. So, JP Morgan jumped more than 4% on Friday, and Wells Fargo rallied more than 5% after their third quarter results beat estimates. Now, more big banks from the US will be announcing their earnings, and we also have Netflix, TSM, and ASML results on the wire that will also be very closely monitored by investors around the world. But elsewhere, Tesla fell nearly 9% on Friday, guys, after the company failed to deliver enough and crunchy details and an encouraging timeline for its robo-taxi at last Thursday's reveal. It seems to everyone that the robo-taxi from Tesla is not ready to hit the streets just yet, and that Tesla is not yet bringing any big revolution to the world of robo-taxis. And provided that the dream of robo-taxis was what was keeping investors in appetite since April this year, as the EV sales are clearly declining across the globe right now, there is quite little reason to keep the positive trend going in Tesla shares. So the shares will probably give back their robo-taxi gains until a further notice. And on the other hand, while the crumbling robo-taxi hopes for Tesla sent Uber and Lyft shares around 10% higher on Friday's trading session. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.